Welcome back everyone to the Audacious Witch channel where we talk about the magic behind the stock market. Yo, Wall Street just pulled the ultimate finesse on all the newbie investors. And you're about to get cooked if you don't know the tea. Today we're diving deep into why Tesla, Lulu, and Qualcomm stocks are all tanking. But we're not starting with the easy stuff. First, we're talking Tesla and Qualcomm because the truth has to be said. And then we're ending with the real sleeper, copper. What does this all even mean for your money? Let's get into it. First up, let's talk about Tesla's robotaxi. You've seen the app, you've heard the hype.
What is happening right now?
But let's be real. It's a whole vibe kill. Tesla launched this ride-hailing service in the Bay Area, and guess what? It's just regular Uber, but make it a Tesla. They're literally using human drivers. When they tried this in Austin, I clocked it immediately. They had a safety monitor in the passenger seat, not the drivers. They called it supervised, but it's not a real level 4 autonomous system. It's just their supervised, full self-driving FSD with the chaperone moved over. Texas law lets them get away with this, and it's pure optics. And now they're pulling the same move in the Bay Area. They're flexing about their robotaxi coverage being bigger than Waymo's. But that's a total red flag. Waymo's is actually driverless. Tesla is just a flex. That's basically the same as an Uber driver who happens to own a Tesla. It's misleading as fuck. Elon was out here a week ago claiming they were waiting on permits, but sources like Politico are spilling the tea. The California DMV and PUC were concerned, so Tesla's lawyers had to hit them with a no-no. We're just doing a ride-hailing service for employees, friends, and fam. Then they went and started hiring vehicle operators in 9 other cities. This whole thing is sus. They're not even applying for autonomous driving permits. And you know why? The data would expose them. Their FSD needs human intervention every 500 miles, which is not giving fully autonomous. They're doing this because Waymo is making them look bad, and Elon's leader in autonomous driving claim is aging like milk. Oh, and while we're on Tesla, let's not forget the bigger picture. Their total revenue has been on a decline for 2 straight quarters. They're losing market shares in their main business, selling EVs. The new affordable Model 2 isn't even a new car. It's just a stripped-down Model Y, and the stock is still trading at 159 forward PE. It's giving AI hype bubble. What a shocker. Qualcomm reported better than expected earnings results for the June quarter, but its shares fell almost 8%. Investors obviously had higher expectations after the stock's big rally since early April. For the June quarter, the tech company reported earnings per share of $2.77, beat Wall Street's consensus estimate of $2.71. Revenue came in at $10.4 billion, which beat analyst expectations for $10.3 billion. The outlook was roughly in line. For the current quarter, Qualcomm gave revenue guidance in a range of $10.3 billion to $11.1 billion versus the average analyst estimate for $10.6 billion. Qualcomm remains heavily out of favor amid general distaste of smartphones, tariff concerns, near-term muted numbers. But I still believe there's value to be had under the surface with an objectively strong product portfolio. The Trump administration has exempted some imported tech hardware products, including smartphones, computers, and other items from tariffs on China imports. However, chips are expected to be covered under a different sector tariff that could be announced in the coming weeks. Analysts expect phone chip revenue to bounce back with the company guiding for 5% sequential growth in phone chip revenue for the fourth quarter, despite the looming loss of its largest customer, Apple, which is switching to produce its own modem chips. Qualcomm is attempting to diversify its revenue streams beyond phone chips. In the third quarter, it saw 23% revenue growth in its automotive and Internet of Things segments and said it is expanding into data center and smart glasses markets. Despite the company's diversification attempts, Oppenheimer analysts said that the company is overexposed to the mobile market, with its diminishing growth and increasing competition. With the $2 billion of acquisition with AlphaWave, that surely has something to do with the 8% drop of the stock price. Okay, so what do Tesla and Qualcomm have in common? They're both tied to the weak consumer. Car sales are down and phone sales are down. You see it with GM, Ford. The Stellantis profits are tanking. The whole market is only holding up because of big AI spending from the Mag 7, but trust consumers are under pressure across the spectrum. A raft of recent data shows households under increasing financial stress across all income levels. Year-to-date consumer spending data combined with rising debt delinquencies suggests the post-pandemic model of economic growth fueled by upper-income purchases of big-ticket items like cars, houses, and vacations is coming under strain. Even top-income earners are falling behind on credit cards and car payments. Spending in the first quarter was the weakest since the onset of the pandemic, and more recent monthly numbers indicated ongoing caution in discretionary categories like recreation services, air transportation, and accommodations, all of which have registered outright declines this year. The luxury industry is on the verge of a necessary reset. Gucci owner Kering reported yesterday that Gucci sales has declined 25% year over year. LVMH's profits dropped 15% in the first half of 2025, with revenue down 4.5%, and nearly all divisions reported flat or negative performance. Now let's get into Lululemon. Lulu stock has reached $200 today. It has dropped over 60% since all-time high. Now it's traded at a PE of 13. For a high-margin business like this, that's literally free money. Wall Street is tripping, and I'm here to collect. Even Procter & Gamble, the bellwether for American consumers' health, is saying people are delaying purchases and shopping less often. Their CFO straight up said consumers are stressed. Both low-income and high-income people are looking for deals. The facade is crumbling. Delinquencies on credit card and auto loan debts from those making at least $150,000 annually have jumped almost 20% over the last 2 years, and faster than for middle and lower income borrowers. A recent Federal Reserve Bank of St. Louis study found that share of people making late credit card payments in the highest income zip codes has risen twice as much over the last year as in lowest income ones. Things are not always as they seem. We have copper prices crash 22% in a day. Why? Falling copper prices can signal an economic slowdown as they often reflect weak demand, excess supply, or broader economic concerns. At the same time, the Buffett indicator is now 2 standard deviations above its average. This is a huge warning sign because this signal has only flashed red in 1970, 2000, and 2021. You know what happens next. So yeah, Wall Street set the trap, but now you have the knowledge to secure the bag. Stay safe out there, and let me know in the comments what you think is going to happen next. Don't forget to like and subscribe for more real talk. Peace!